In October of 2008, the whole world knew Volkswagen was overvalued. Hedge funds piled in to short it, and for 2 days, Volkswagen became the most valuable company on the planet. Stocks went up over 300%. Shorts lost billions. Some traders reportedly wiped out completely. They were right about the valuation, and it didn't matter, not even a little bit. Today, I want to talk about SpaceX. Ticker SPCX. A $2.5 trillion company that just IPO'd with a float so small it would make Volkswagen blush. And there are two ways to play it. You can buy it or you can short it. Both can make you money. Both can absolutely destroy you. But here's the thing, nobody's telling you. It's not about which side you pick. It's about when you pick. Stick around because I'm going to show you the exact window where shorting SpaceX goes from financial suicide to maybe the trade of the year. Fun fact, that 2008 Volkswagen squeeze, a German billionaire named Adolf Merkel was short VW. When the squeeze hit, losses were so catastrophic it contributed to his financial ruin. It's one of the most famous cautionary tales on Wall Street. And I bring it up because the setup we have in SpaceX right now rhymes with it almost perfectly. So let's try to understand a little bit before we try to trade it. SpaceX has about 13 billion shares outstanding. But how many are actually available to trade? About 4%. Yeah, 4%. That's just over 500 million shares in a $2.5 trillion company. Everything else is locked up. It's held by Elon, by employees, and venture investors. All who can't sell it yet. When you have that little supply and any real demand, the price becomes a coiled spring. A tiny amount of buying sends it flying because there's nothing there to absorb it. And the chart is already showing us the mechanics of SpaceX IPO'd at 135. Within the first week, it was bid up to 225. It's already fell all the way back to 152, and today it sits at 162. But here's the thing, the actual forced buying hasn't happened yet. That's July 6th and 7th. Right now, we're sitting right below the trigger level I'm about to show you. The spring is coiled. Now here's where it gets crazy. Because of a NASDAQ rule change back in May, SpaceX got fast-tracked into the NASDAQ 100 just after 15 trading days. SpaceX officially joins the NASDAQ index on Tuesday, July 7th, which means after the close on Monday, July 6th, every passive fund ETF that tracks the NASDAQ 100, think about the Qs and any ETF like it, is mechanically forced to buy this stock. They don't get a choice. They don't care about valuation. They have to buy to avoid tracking errors. It's forced buying. JP Morgan estimates that $4.3 billion in forced buying from the NASDAQ funds alone. Add in the Russell 1000 and every other benchmark, the estimates run from 22 to $27 billion. Billions of dollars of people that don't care about the buying price chasing 4% float. You don't see the problem for the shorts yet? This is the part I need you to hear. Right now, with SpaceX sitting at 162, just below the trigger I'm about to describe, is the danger zone through late July. This is the worst time to be shorting the stock. So here's the thing. It doesn't matter if you're buying puts, using an ETF that shorts the market, or actually shorting. The danger is the same. This forced buying can wipe out any bearish position before the thesis ever plays out. The right direction, wrong timing, the same result happens. This is the Volkswagen setup. Exact setup. Cornered float, forced buyers, everybody screams like it's overvalued, and that is exactly the environment where shorts get detonated. Being right doesn't save you if there's no shares to cover into. So if the setup is this terrible, what should we do? Here's the one rule for this trade. Don't short the scarcity. Short the flood of new stocks. The edge here was never SpaceX is overvalued. Everybody knows that. The edge is that the supply of shares is about to explode. You time this to the unlock calendar, not to the valuation. Let me walk you through the calendar. Phase 1, late July into early August, Q2 earnings. This is the first crack in the dam. Somewhere between 20 and 30% of restricted shares from early investors and employees unlock. And watch this detail because it's beautiful and terrifying at the same time. There's a price trigger baked into the lockup. And if the stock trades at or above $175.50, it's 30% above the IPO price. For enough days, insiders get to sell an extra 10% of their shares early. Think about the loop. The forced index buying pushes up the price. The higher price trips the trigger. The trigger unlocks more supply. The very thing pumping up the stock is what arms the bomb underneath it. And here's the fork you need to watch. The stock is 162 right now, below that trigger. On July 6th, billions in forced buying hits. If it pushes us through 175.50, trigger fires. The loop arms early. This would be dangerous for July 6th shorts. If buying gets absorbed and price fades, path B. The supply flood sets up cleanly. Prime for shorts. The number to watch is 175.50. Phase 2, August through October. Every couple weeks, another 7% of insider shares unlock. Day 70, 90, 105, 120, 135. That's 4% float roughly doubles and keeps climbing. And here's what that does for a short seller. Every slice means more shares available to borrow, which means the cost to borrow drops. The trade gets safer as supply grows. Phase 3, and this is the prime window. Late October through December 8th, Q3 earnings unlocks a massive 28% chunk. And then on December 8th, day 180, 100% of the non-Musk insider shares are free to trade. By then, the one-time index buying is long gone. The forced buyers have already bought, and all that's left is a wall of supply hitting the market with no price incentive demand underneath it. That's the window. If you want to know how this movie ends, watch Facebook in 2012. Facebook was the biggest and most hyped IPO of its generation. Sound familiar? It was priced $38, and then as its lockups expired and insider shares flooded the market, it did not just drift, it cratered and fell to around $17.50. More than 50% haircut. Not because Facebook was a bad company, it obviously wasn't, but because for a window of time, supply completely overwhelmed demand. The people who bought the hype at the top got run over. That's the template for SpaceX. Volkswagen teaches you the risk of shorting too early, the squeeze. Facebook teaches you the opportunity of shorting at the right time, the flood of new stocks. Two of the biggest companies of their era, and they hand you both halves of this exact playbook. Now a lot of you are going to say, I'm not messing with borrowing fees and limited losses. There's an ETF for this, SSPC. It's 2 times leveraged, inverse bet on SpaceX. If SpaceX goes down, this thing goes up double. And you'd be right, your downside is capped at what you put in. But I need to warn you about this thing, because it will trick you. This ETF resets every single day. That daily reset causes something called volatility decay. In a choppy, sideways market, this ETF can bleed value even if SpaceX goes absolutely nowhere. It's a short-term trade. It's not a buy and hold. And the leverage cuts both ways. If SpaceX squeezes up 50%, which into that July rebalance is not crazy, A 2 times inverse product is looking at a total wipeout. If you buy this ETF and hold it into that danger zone, you can have the right long-term thesis and still go to zero before you're ever proven right. So if you're going to use this ETF, it belongs in the back half window, short, defined, when all the new stocks hit the market, not thrown in the front of July squeeze and prayed over. Right thesis, wrong timing, you still get zero. Play this script 5 times if you have to. And one more thing hanging over all of this, Elon Musk, he signed a strict 366-day lockup. His roughly 6.4 billion shares, about 40 to 46% of the company, can't hit the market until June 13th, 2027. That's the largest single overhang in market history. It's not short it tomorrow event, but it's a ceiling on the stock that isn't going anywhere. Remember, Musk controls 85% of the voting power. You, the shareholder, are essentially along for the ride on whatever he decides to do. And he does what he does. All right, so where are we? Right now, the stock's at 162. It's below the trigger, day out from billions in forced buying. I'm not shorting this thing. If anything, it belongs to the longs. If I'm wrong, I'm okay with that. Watch, if July 6th pushes through 175.50, that tells you which path we're on. But as we go from August into December supply wall, as the float doubles, borrowing gets cheap, the index buyers go quiet, the insider selling floods in, that's when the risk reward is on the short side, finally flips in your favor. Don't short the scarcity. Short the flood of new stocks. Time these unlocks. All right. Now tell me if this helped you out. I'd love to hear your comments down below, and good luck. Take care. Hope this all works out for you. Bye-bye.